Very big news that the U.S. Treasury Department is putting forward to the White House for review the CARF regulations. Now, CARF stands for, that's CARF, stands for Crypto Asset Reporting Framework. The Crypto Asset Reporting Framework is a fairly lengthy document developed by the OECD, Organization of Developing Countries, and this has been signed off by nearly 90 countries have signed on to the CARF framework that they're going to implement it. Implementation is effective starting in 2027. So it's really a year away, if you will. The fundamental aspect of this framework is it puts a burden on each participating country to require all the crypto exchanges and services, or what they call virtual asset service providers, to collect information about who the clients of the services are, basically KYC, due diligence information. They have to collect this. And also amongst that is the tax ID number in which country the person is a tax resident of. So they have to report all this at the end of the year. A exchange will then report to that country the client's trading activity. Now, what information is reported? So let me back up a second. So, if you have a exchange in Malta, like Binance will have to report to each country in a participating network what the activity was on any user of their services at the end of every year. So this is what the Common Asset Reporting Framework is. It's very similar to something that's already in place in the rest of the world called the Common Reporting Standards, which reports bank balances at the end of the year to foreign countries where you might be a tax resident. The US does not participate in the Common Reporting Standards. It has its own method called FATCA, another discussion. But the Common Reporting Framework, the Treasury Department is proposing to the White House that they should participate in this. The Strategic Crypto Regulatory Bill, the Working Committee bill that came out in the summertime, also supported implementing CARF. Now, what does that mean? CARF represents the reporting of all transactions to another country. So not only just the sales, but also exchanges and transfers. And when it comes to transfers, it's going to report either the transfer to or the transfer from wallet address. Bottom line is the 1099 DA reporting requirements completely satisfy the CARF reporting obligations that the IRS would have if we signed up for it. So just think of CARF as being 1099 DAs coming from foreign countries. Now, technically, they will not be 1099 DAs, and this is a very significant difference. 1099 DAs come from U.S. companies reporting to the IRS, and you get a copy of it as a taxpayer in the month of January. But these CARF reporting, it'll go directly to the IRS, and you will not get a copy of it. You will not know what these foreign crypto exchanges are reporting to the IRS about your trading activity. The IRS will then use that information along with the CARF data, and they'll probably plug it in with one of the tools that they use, like Palantir, to come up and identify which taxpayers have reported all their crypto activity and which did not. And they're going to audit those people that did not. This is very significant. The news is tightening around the crypto traders. The ability to hide and not report is disappearing. It's been our opinion for over the last 7 years that at least 75% of crypto investors in the US are not reporting all their crypto income to the IRS. This is not something people can afford to do much longer. It's becoming increasingly impossible to hide. And once the CARF reporting comes out, so that'll be in the year of 2027, that will be collected and then reported to the IRS from the foreign countries in beginning of 2028. So you got about a year away for this to happen. But that means you have about a year to start to get the rest of your affairs in order. Now, here's what's really critical to you as a taxpayer. The IRS is getting information about your private wallets. They're getting the addresses. From that, they can go, depending upon the blockchain, they can go on the blockchain and see what sort of activity you had. If they can look on the blockchain and see that you disposed of an asset, you traded it away, then they can go look on your tax return and say, did the person account for this trade as cost basis, as a sale? And if it didn't, then you start to become subject to an audit. It's a very serious development that every crypto trader has, and you have a very limited time to start to really get your tax house in order if you want to protect yourself from a very heinous attack vector that the IRS is now polishing to come after crypto traders.